As we approach the end of 2015, the FTSE 100 is down by 8 to 10%, weighed down by two sectors in particular, oil and mining. Now, fellow heavyweights, pharmaceuticals and banks haven't covered themselves in glory either, with declines of 6 and 19% this year, but they look like good efforts compared to the diggers and drillers. As of the 15th of December, the FTSE all-share oil and gas producer sector was down 26% and mining by 52%, enough to leave them pretty much at the bottom of the sector performance rankings. The question that therefore faces all investors as we get ready for 2016 must be, is it now the time to start looking at these downtrodden sectors again? Hello, I'm Russ Mould, AJ Bell's Investment Director, and in this edition of our regular market review, Breaking the Mould, I'm going to focus on the oil and mining sectors to see whether they can start to bounce back in 2016 and cause a fuss for the right reasons for a change. Now, first of all, let's not kid ourselves here. Oils and miners have been absolute horrors in 2015. Regular viewers will recognise these charts, which are kindly provided by our good friends at Shares Magazine. They show the weekly performance ranking of oils and miners in relation to all 39 FTSE all-share sectors. 1 is the best, 39 the worst, and as you can see, oils and miners right now stand at 37 and 38. That's not good, but it is over. Ancient history. The markets are forward-looking, and the key now is what those stocks will be doing and sectors will be doing in 2016 and beyond. We all know the news is grim. Oil at 7-year lows, Bloomberg Commodity Index at 16-year lows, mining dividends being cut, earnings forecasts under pressure. But again, now we have to work out, is this all in the price because it's known and therefore is value emerging? One simple way to do this is to look at price relatives. If a sector or stock trades at a multi-year low relative to a benchmark, there has to be a chance the bad news is at least partially, if not fully, reflected by its performance. The FTSE All-Share Mining Index in its current form dates back to 1986, and a 30-year history is quite good enough for our purposes. This chart here shows the miners' relative performance by dividing the FTSE All-Share Mining Index by the FTSE All-Share itself. If the line rises, miners are outperforming. If it falls, they're underperforming. So, yes, miners have underperformed horribly in the last few years, but the UK mining sector still trades at twice its historic low relative to the all-share. This suggests the worst might not be over yet, if history is any guide, or at least any recovery could be a very bumpy one. Remember, there are also still 7 miners in the FTSE 100, just in case you'd forgotten: Anglo American, Antofagasta, BHP Billiton, Fresnillo, Glencore, Randgold Resources and Rio Tinto. More than one wise and experienced fund manager has whispered to me that he'll only be looking at the mining sector when that figure's fallen to 1, replicating the mass inrush and then outflow of technology mining and technology and telecom stocks that characterised the 1998 to 2003 period. Now, when it comes to oils, we've got the same 30-year chart, same sector relative. And the good news here is oil's trading within 10% or so of its 30-year relative low on a sector basis compared to the FTSE all-share. It's also possible that the oil stocks are further down the road than the miners in adapting to this new world of lower prices, although December's inconclusive OPEC meeting in Vienna is prompting fresh drops in crude below $40 a barrel, and the big oil firms' cost-cutting and capex plans appear to rely on 60 or more. So in sum, oils do look to factor in more bad news than the miners, and there are just 3 of them left in the FTSE 100, BG, BP and Shell, and BG is due to disappear next year anyway when Shell buys it. But what both sectors really need is a rally in underlying commodity prices, and without that they may continue to struggle, judging at least by recent market action. So you need to do your research on the raw materials they produce and then any individual stocks before you can decide whether valuations are appropriate or not, and whether these companies fit with your individual overall strategy, time horizon, target returns and appetite for risk. Thank you for watching, and I look forward to seeing you next time.